Global rating agencies, Moody's Investor Service, has cautioned that Nigeria's banking sector could face renewed profitability pressures following the Central Bank of Nigeria's decision to cut its monetary policy rate, MPR, to 27% from 27.5%. The CBN said the move aims to sustain disinflation, support recovery, and encourage credit growth. However, Moody's warned the lower rate could shrink banks' net interest margins as lending and government security yields may fall faster than deposit costs adjust. With net interest income contributing 62% of banks' operating income in 2024, the agency said the reduction in the cash reserve requirement offers only limited relief for the sector. Oluwayemisi Sunmola, banking research analyst at Vetiva Capital, joins me now. Good morning. All right, kindly unmute as we press on with the conversation. So, there are warnings that banks' profitability could shrink in the coming months. Is that good or bad news based off of the interest rate reduction?
What this would mean for the banks is that we could see some sort of compression in their net interest margin, which would be, and the net interest margin basically is the bank's lending yields minus their funding cost. So what could actually cause their NIMs to actually reduce would be that a lower policy rate typically tends to lower yields on new loans, and also the return on government securities like the fixed income instruments like the treasury bills and the likes, while the wholesale and deposits funding costs would also adjust, but tends to adjust more slowly. So what we would see is that if this asset yield fall faster than the funding costs, we would see the NIMs narrow, which means basically less spread of income per unit of asset and therefore lower core profitability, all things being equal. So with a lot of the banks which have a significant portion of their earnings from this net interest, this would translate directly into earnings pressure unless the cost of volumes offsets are basically found. And that was basically what was highlighted by that report.
And of course, much later, we'll balance this out to see what this means for the broader economy. But we know that higher interest rates have driven FPI inflows, I beg your pardon. And that has somewhat buoyed, some will say, dollar inflows into the economy. So what does this mean? Lower yields, lower interest rates. What does this mean for FPI? And how does that trickle down to, the economy?
So on the net, we would see generally rather higher yields actually increases FPI investment in the fixed income markets, right? In the sense that the rates on a lot of their inflows gets more interest, so they are generating more income. And in turn, this could also, this largely drives on the short term capital inflows into the Nigerian economy will be used in capital investment in order to boost the economy in general. So with lower inflation, with a lower rate, we could see some sort of a capital flight, as a lot of these foreign portfolio investors would go and hunt for more returns in other favorable assets, and in turn, so we could also see that also trickled down of some sort into the equities market. However, in general, on the fixed income space, a drop in rates is generally negative for that market.
So concerns around capital flight. But let's take a look at the broader economy. We know there have been cries for lower interest rates. Manufacturing, they have, felt it perhaps the hardest when it comes to borrowing costs. So how do you see this 50 basis point cuts affecting borrowing costs for businesses and households?
So in terms of the lower interest rates, which was largely driven by the decline in the inflation as we see. So we see inflation still remain elevated. So a direct impact of this is that one, a lot of this in the manufacturing sector will see the rates by which they get a lot of their loans for investment would actually see that trickle down, and that would be net positive for their bottom line. So we would see the rate cut actually favor a lot of the manufacturing sectors, manufacturing sector as well as the consumer goods sector in general, of some sort that would be some largely negative for the banks, and they would need to actually grow their loan books in order to offset the impact that this rate cut would mean for their books.
Mm-hmm. And I mean, we know that we have seen, as you have mentioned, sustained, and as Moody's report mentioned, sustained disinflation. But there are still those that believe that MPC should have been a little more cautionary with the rate reduction, considering how fragile the economy is. Do you agree? Perhaps they should have stalled a little more with interest rate reduction. What are your thoughts around that decision?
So it's kind of mixed, because partly on one end we are saying that headline inflation has shown consecutive monthly declines. For August, we saw headline inflation at 20.12. So we are basically saying that the disinflation signal is real, but although we are seeing that the disinflation signal is real, on another end, inflation still remains very elevated in absolute terms, and upside risks such as food inflation, FX shocks, as well as subsidy changes still persist. So the current trend basically supports some sort of a cautious optimism, but inflation is still far from low and stable. So what we are seeing is that the CBN is currently easing because inflation is moderating, right? But not that price pressures have actually been completely eliminated. So it's of some sort justified, but there are still other headwinds that would feed negatively into the general sentiment.
So proceed with caution. And obviously,
Yes.
Looking at the upside, what sectors do you think will benefit most from this decision, from the lower interest rates? And how can we ensure that they actually get the benefits from this lower interest rates?
Okay, so like I said before, the sectors that would largely benefit from these lower rates will be the consumer goods sector. Would also see the manufacturing sector also gain for this, and a lot of the small and medium-sized enterprises, as they will be able to get a lot of their investment funds at cheaper rates. In terms of the negatives, we could see that have a slight impact on the banking sector if some sort the banks are not able to grow their loan books in order to offset whatever rate pressures that would mean for their names.
And as you have highlighted, of recent, 62% of banks' income came from the net interest. How do you think banks should rethink their revenue models and how they generate more revenue so that they can still see sustained profitability?
So what we generally think is that the banks should adapt to this current rate trend and not necessarily abandon the model. So basically, a high reliance of the banks on net interest income, which is largely driven by the rates, would make these banks actually vulnerable to rate cycles. So strategic moves they could look to adopt to be: one, diversify their fee income, their fee revenue, that is payments, custody fees, as well as transactions services. So they should move to increase that, as well as also grow a higher margin on retail and small and medium enterprises lending. Of some sort, also expand on their wealth and asset management fees for a lot of the banks that have other businesses and invest in digital distribution. Basically, they should rebalance a lot of their revenue mix, and this will generally be a better it will be better medium term, a better medium term priority for them if the easing cycle continues on the long term.
Mm-hmm. And we've also seen the cash reserve requirement. We've seen it reduce. How effective do you see this being in cushioning banks from profit shocks, I beg your pardon?
So on one end, we'll see that reducing the cash reserve requirements basically frees up statutory idle balances and also releases liquidity, which can be deployed into other interest earning assets. And this would basically provide an immediate cushion to the margin pressures by increasing the earning assets, or in some sort lowering reliance on expending on a lot of the expensive wholesale fundings. In general, the CRR courts don't generally change the spreads on these loans, but they would improve their balance sheet flexibility. So the cash reserve reduction is helpful, but not full-fledged help in helping the compressed NIMs. So it will just be some sort of a soft hedge on the effect it would have on the bank's NIMs.
All right. Thank you so much for your time, Oluwayemisi Sunmola, Banking Research Analyst, Vetiva Capital.
Thank you very much for having me.